Hello, and welcome to Virtual Investor Conferences. On behalf of Harbor Access Investor Relations, we're very pleased you joined us for the Global Small and Mid-Cap Investor Conference. We'll kick off today with a live presentation from Ecora Resources. Please note you can submit questions for the presenter in the box to the left of the slides, and you can also view a company's availability for one-on-one meetings through the Scheduled Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Mark Bishop LaFleche. He is the Chief Executive Officer of Ecora Resources PLC, which trades on the OTCQX Best Market under the symbol ECRAF and on the TSX and LSE under the symbol ECOR. Welcome back, Mark.
Well, great to be here, and thank you so much for hosting me once again. It's always a pleasure to present Ecora. So kicking right off, and what is our purpose and our strategy and our vision for Ecora? Well, it's very, very simple. At Ecora, our vision for this business is to be the leading go-to royalty company that offers global investors relatively de-risked allocation to the energy transition thematic. And our execution strategy is very much to acquire and build out our royalty portfolio over high quality operations with strong management teams in good jurisdictions that have exposures or plan or have produced their commodities in a responsible and a relatively more sustainable way. So our strategy is to target these commodities, as I mentioned, which are really fourfold. The first, commodities which are integral to renewable energy production. The second, to the transmission of that energy. The third, the consumption or storage of that renewable energy or low carbon energy. And on the right of this slide, what you can see is a sort of a checklist. We've done a great job of building out the core of this company to be exposure to copper and nickel and cobalt, with some vanadium and uranium. But there are other commodities that we'd like to add, such that in the future, Ecora is perceived to be the best, lowest volatility and most attractive way to play the energy transition thematic and relatively de-risked from going directly into a mining equity. This slide gives you a feel for where we've come from and where we're going. Just under 10 years ago now, this company was basically one asset that was metallurgical coal. And over the past 10 years, our first phase was just to replace the income from that asset as it's expected to run off in the near future. And then number two, to add a lot more growth. And then we're now in the third evolution of this business, which is in our minds to further diversify our royalty portfolio in terms of commodities, counterparties. And then from there, add incremental scale such that the business benefits from better trading liquidity. While Ecora itself is a small cap business, it's important to keep in mind that the operators of our assets are not. The market capitalization of our producing counterparties is somewhere around $200 billion. And so, it's a nuanced point, but an important one. Ecora itself is small capitalization in terms of our trading liquidity, but the folks who operate these mines typically for our large exposures are some of the largest and most experienced mining companies in the world. The same is said for our development pipeline. One of our most important growth assets is a copper and nickel royalty in Australia, currently in construction by BHP, along with a copper development project in Chile, owned and expected to be built by Capstone Copper. Looking ahead to the future, one can see very clearly on this slide a mix of the transition from the old to the new. And that's really where we find ourselves today at Ecora, where we're transitioning from what was a history of cash flow generation tied primarily to one asset from the Kestrel mine. And over the next few years, we'll see that sort of ramp off, and in parallel, a ramp up of some of our producing royalties in copper and cobalt and uranium and vanadium, amongst others. And then beyond that, in the medium term, a number of new projects which are expected to come into production, which will benefit our royalty income line, such that from where we sit today, based on our producing portfolio of future-facing commodities, which is the solid blue line above medium term, overlaid that green line is an asset that's in construction, and then the orange line that gets us to potential of royalty income in excess of $100 million are assets that are expected to be starting up in the next few years. So we're really thrilled with how this company has really grown from being a single asset business to one which offers diversified exposure across the commodity complex, but primarily in copper, but also having a fantastic revenue growth profile beyond the met coal asset in our portfolio. And at our core, Ecora's exposure from a net asset value perspective is very much copper. Our copper growth pipeline is amongst, if not the best, copper growth pipeline of any royalty company. Today, our exposure is around 50,000 tons. And once over the next decade, we have expected growth to take us to just under 600,000 tons. So pretty substantial exposure to copper, which is ultimately one of the materials that's most required for electrification of energy consumption, and that there are very few substitutes. But number two, it's a metal that has a very well-established use in other sectors of the economy, such that the core of Ecora is our business at its core is diversified across the energy transition end markets, but also really well-established industrial end markets, which it's very hard to imagine the modern world without copper. So what's the opportunity for folks today? I mean, it's something that we've been watching very, very carefully, and that it has been sort of disconcerting, and that we've seen, in part as a result of macroeconomic challenges globally, global conflicts, and the escalation potential for two wars, amongst other factors, in part including some uncertainty and volatility around our Kestrel mine, some pretty not too dissimilar to many of the equities, but nevertheless, evaluation at Ecora, which is such that we are currently trading for less than the value of our producing asset, if one assumes the value calculated by research analysts. And the opportunity, I suppose, for folks when they look at Ecora is they're able to buy exposure and potentially benefit from what we see to be very high quality growth in the form of assets that are being built by, as I mentioned earlier, BHP and others that are expected to be built in the near future, Capstone and Brazilian Nickel being the most relevant here. So the equity is trading far below the net asset value. And we think, in time, as we go through this transition over the next few years and these assets are incrementally de-risked and approach production, the equity should, one would reasonably expect, or better reflect the intrinsic value of the company's royalty portfolio. And to that end, in the near term, we really do anticipate quite a lot of news around our core assets. At BHP, West Musgrave, the mine is in construction. So that's one we just need to watch and make sure, and as best we can, monitor that one to watch that one hopefully come into production in H2 2025 or H1 26. And beyond that, Santo Domingo, Mantos Blancos, POE, and Voisey's Bay all have some really interesting de-risking events or near-term catalysts in terms of their production profile or visibility. So across the board, there's a lot to watch, and there's a lot to be happening organically in our portfolio over the near term. Over the next 2 years, we will think very carefully about capital allocation, because we do find ourselves in an environment where, in our opinion, the valuation for many of the commodities tied to electrification and energy transition don't really, the prices environment today seems to not entirely reflect the fundamental outlook. And therefore, in that environment, it's a very favorable time to be deploying capital from a purely cyclical perspective. And therefore, maintaining balance sheet strength during this period has been and always will be one of our key motivations when we think about capital allocation. ultimately, we believe that one of the core reasons some investors like or buy royalty companies for exposure is for de-risked exposure to the mining sector, and therefore we feel it'd be imprudent to impinge upon that fundamental aspect of the investment case by sort of running the business with too much leverage. The next thing that we'll be looking at carefully is funding further acquisitions. As I mentioned, if you're building a royalty company, like anything, logically one should look to deploy at times of cyclical weakness and to pull back when commodity prices are much higher. And based on the outlook today, it doesn't appear as though asset valuations are likely to rebound materially for at least 12 to 36 months. So there does appear to be a very good window to help projects and to continue to fund really good quality operations. From there, dividends and last other quarterly returns as and when we feel the company has excess cash. So to wrap it all up, I think with Ecora, it's a simple business. I mean, ultimately, our business model is to buy royalties over very high quality projects. We've assembled a royalty portfolio in the right jurisdictions with strong counterparties that appear to be well located on relative cost curves, such that they are very well positioned, or as best positioned as one could hope, to operate through cycle. The business today has an exceptionally strong growth profile. The company has a history of capital allocation discipline and has in the past returned capital to shareholders in the way of a dividend. We feel, whether you like it or you don't like it, in any event, we feel we've been very transparent as to what we've acquired, how we've acquired it, the investment cases, and so thus there's a long track record for folks to evaluate should they be considering an investment into Ecora. We've really transformed our sustainability profile and disclosure. And last, but certainly not least, the business's valuation appears to be substantially less than both broker estimates as well as net asset value estimates by research analysts. So with that, we'll turn over to some of the Q&A. So the first question I see here is, why do you believe the value of Ecora is not currently reflected, and what are the catalysts for revaluation? So on the first part, why do you believe the value of Ecora is not currently reflected? There's a number of factors. I think bottom up, one of the key factors is that the company is going through a transition. It's going through a transition in terms of the producing assets into a new set of assets that are expected to come online. And that is just a change. And ultimately, any sort of change is different. And I think in part, that's a factor for why some folks are a bit more cautious about Ecora. And therefore, the catalysts are fundamental. And as I mentioned earlier in the presentation, a number of these catalysts are expected in the next 6 to 12 months. And then from a top-down perspective, part of the challenge is, as I mentioned, just a global macroeconomic uncertainty. Furthermore, in part also combined with the potential for the escalation of two global armed conflicts, which ultimately, in our opinion anyways, from what we can see, has created a much more, has weighed upon equity valuations. I think the business itself, though, bottom up, is in very good shape from what we can see today anyways. On the one hand, the business has a manageable level of debt, has great growth options, and furthermore, has the right portfolio for the next decade. And in the short term anyways, still has fantastic tailwinds in the form of revenues from our metallurgical coal royalty, where prices have been elevated far above broker consensus, or spot prices currently are far above broker consensus forecasts in any event. And then the next question is, would it be reasonable to assume the dividend will be maintained until new revenue streams kick in, assuming, of course, stable metal prices? And on that point, I think part of it will come down to the big question here is assuming, of course, stable metal prices. Because as we look forward into the future, there's a huge amount of volatility expected in the world. So to the company, returning of capital has always been a real cornerstone of how we've approached capital allocation. And as much as we think very, very carefully about the factors as to why the share price is trading where it is, we also think about capital returns very, very carefully. So when we look into the future from here, I think ultimately it'll come down to, number one, what's the outlook for metal prices? And then number two, what is the outlook for growth? And when you combine those two together, the ultimate point comes back to, from there, what does the balance sheet look like? And ultimately, our view is we have to do what's right for the company. And ultimately, if you have to make a tough decision, doing what's best for the company is ultimately the best way to drive value for shareholders. Can you speak to the recent production at Kestrel project and contributions to Ecora and expectations for 2024? So one of the things that's happened in the past year that I mentioned earlier, but since the question has been posed, is we've seen much greater volatility around the income profile at Kestrel. And that's very likely to continue over the next 2 years, where for some periods of the year, royalty contributions from that asset will be minimal or potentially zero, and in other quarters, very substantial. So what I would encourage folks to do when they think about Ecora and Kestrel contributions over the period of 2024 into 2025 is to see it very much on a 1-year basis, because we do anticipate volatility in the production profile. At this stage, we anticipate production next year being roughly in line or slightly above where it is this year. But I think we'll have more visibility on that as we approach the end of the year. Currently, we receive forward-looking estimates that are 12 months forward. So how do you source your transactions? This is a very good question. And I think ultimately at Ecora, we've had a lot of success in terms of sourcing new transactions by virtue of just having been a royalty company for a number of years. That allows one to build a great network across the mining community and to build relationships. And it's as simple as that. We feel to be successful in the royalty and streaming industry, one needs to be very patient when one sees something they like, to ensure that you put your best foot forward and try to get it into the portfolio, because some of these assets, if you miss it, you might never get another opportunity to own it. Can you say more about the growth assets in the portfolio? Which are you most excited about? And that we certainly can. So I might take you back to a slide I touched on earlier. So I mentioned it earlier already, but just to reiterate the point, one of our amongst interesting growth assets is this copper nickel royalty that's in construction by BHP. This is a long life asset. It's well positioned on the cost curve. And if anyone isn't aware, BHP is the largest mining company globally, in the West anyways. So it's a great counterparty. There's a lot to love here. And of course, over the next decades, there's an enormous amount of upside potential in copper prices on the back of really attractive fundamental outlooks. The same to be said for Santo Domingo. While Capstone Copper is not as large as BHP, Santo Domingo, the Capstone Copper management team, has proven the ability to bring projects online, most recently with Manto Verde, almost in line with initial capital cost estimates, which in itself is something really to be applauded in the mining sector. And furthermore, the team has a lot of experience operating and constructing operations in Chile. The Piauí project is an equally exciting growth royalty. It's a nickel cobalt opportunity. The project is expected to do around 24,000 tons of nickel every year. What's interesting about this mine is that they plan to produce nickel hydroxide. And nickel hydroxide, of course, is an intermediary product to making nickel-based battery cathodes. Therefore, product out of Brazil with a really low carbon footprint that can flow into an IRA compliant supply chain for auto manufacturers in the US is a very rare thing. Certainly there are not many projects that can be potentially online within 2 years from now that can deliver this product. And to wrap it up, I mean, this is the growth profile of the company over the medium term. And it's particularly exciting because the solid blue line you see on the right under medium term are all acquisitions we've made over the past 10 years materially, as is this light green and the orange. So what this slide effectively shows is the growth that we've put into Ecora in a very patient, deliberate, and methodical way. So here you talked about the basket of commodities. If you could add something tomorrow, what would it be? So to take that question, why don't we look at this slide? And at our core, the business is copper, and that's the one thing that we'd always take more of, for the reasons I've already mentioned. And we'd very keen beyond that to keep the center of our portfolio in base metals. Beyond that, though, there are commodities we'd love to add, and those are basically lithium, zinc, high purity manganese, graphite, rare earths, tin. And we don't necessarily feel like we need to be overweight any of these commodities, but we feel like the exposure for the right project, the right counterparty, would really help round out our portfolio, would really help reduce the volatility of our earnings. So for example, if one commodity is doing well, another might not be doing so well cyclically, and therefore we just have reduced volatility as we move forward through time. And then last, could really help position Ecora as this one-stop shop that there's not really there are not that many other equities that can offer what Ecora could offer if we're able to successfully execute on our strategy. This is what are the biggest risks to the development assets delivering the growth trajectory you showed? Well, here, like in mining, there are always risks to a development timeline. So first and foremost is financing. BHP is well capitalized to fund the production at West Musgraves, and Capstone Copper appears to have the balance sheet to do so as well. At POE, the project is currently in the process of seeking to raise construction financing. So that project and its timeline was very much linked to the timeline of financing. That timeline of financing appears to be on track. We had hoped that there might be an update in H2 of this year. It's still possible, it may slip to next year, but as of now, things appear to be moving forward. But of course, until documents are signed, we'll have to wait and see. And then beyond that, it's permitting. BHP's West Musgraves is fully permitted, Santo Domingo is fully permitted, shovel ready, and POE equally materially shovel ready. And then beyond that, there's construction and execution risks. All these folks appear to have the teams and the capacity to build these projects and bring them online. So, I mean, one could certainly, those are the material risks, but there are others, of course, when one thinks about bringing mining projects into production. And next is, can you update us on the progress at POE and your decision criteria to proceed with add-on financing? Well, I just mentioned the timing. At this moment, we're not able, unfortunately, to provide any other additional color to the timeline at the financing process at POE. We do anticipate, however, that the financing process, should it be successful, will conclude sometime in 2024. In terms of our decision criteria to proceed with add-on, we visited the mine earlier this year. We were impressed by what we saw. At this stage, no formal decision has been made, but as I mentioned, we were very impressed with what we saw. So I'll pause here for any further questions. No? Okay, well, thank you very much for your interest. Thank you for joining us today. Hope you found this presentation informative and interesting. And should anyone have further questions, please don't hesitate to reach out. We're happy to provide further information as